Let's work through an example of inventory transactions now that we know the difference between a perpetual and a periodic system. So this exercise gives us beginning inventory of 25,000, and then there are some inventory purchases as well as some freight. We've returned some inventory to suppliers for a full refund, and we have counted the ending inventory at $30,000. We've made some sales of $250, and those sales were for inventory that originally cost $148. To record these in a perpetual system, the very first transaction is to record our purchases. We record purchases directly to the inventory account using a perpetual system. In periodic, you'll recall that we use the purchases account. This was on account, it said, so we'll say accounts payable as the credit. The second journal entry is to record the cost of the freight that they have paid in cash, $10,000. That is a cost that is required to get the inventory ready for being sold. So it goes directly into the inventory account as a cost of the inventory. They paid cash for that transaction, so we'll record the credit to cash. The next transaction is to record the inventory that was returned to suppliers for credit. So we're going to credit inventory, but the debit would be to what we owed for the inventory. We don't owe it anymore. So I don't owe any accounts payable for this return, and that was for $12,000. And the credit goes directly to inventory because we are planning to return it for $12,000. The fourth journal entry is to record the accounts receivable for the sales that we made this year of $250,000. They counted the inventory of $30,000 at the end, but we don't need to do anything with that because we use a perpetual system. So our system has been updating the inventory accounts every time we make a sale, and our ending inventory will be accurate automatically, but it's good practice to count it anyway and compare to what we have. So now we're going to record the sale. That's accounts receivable. It was not in cash, and that was for $250,000. Looks like I grabbed accounts payable. So let's switch that to accounts receivable. And then let's record the credit to sales revenue for $250,000. The next journal entry is to record the cost of that sale. So record cost of the merchandise sold of $148,000. We can go ahead and credit cost of goods sold for $148,000, and we will credit inventory for $148,000. The final journal entry is to record the end of period adjusting entry, and we do not have any journal entry required here because, again, we are using a perpetual system. So when we recorded that sale, we automatically updated our inventory for the transaction. Now let's look at what it would be in a periodic system. If we were using a periodic system, instead of debiting the inventory account for that first purchase, we're going to debit the purchases account. It's just a separate inventory account that we keep apart from our regular inventory until we count our inventory at the end of the year. And this was on account, just like in the other method. Next, we're going to record the freight. Instead of putting it into the purchases account, we put it into its own freight account. So we'll call that freight in. Everything just stays in separate accounts until we count the inventory at the end of the year and make our adjusting entry. And that was cash of $10,000. Next, we're going to record the merchandise returned. We can debit accounts payable just like we did in the perpetual system, but we can't credit inventory because we have not put that into the inventory account yet. It's sitting in our purchases account. So we're actually going to use a contra account to offset our purchases. And that is a purchase returns. So purchases is an asset account, just like an inventory, and purchase returns is a contra asset account. So when we use the periodic system, we use individual accounts for each of the entries to inventory. And then at the end of the year, once we count it, we'll wipe out all of those accounts and move the ending balance into inventory. The next transaction is to record the sales, and this is the same under both methods. We debit accounts receivable for $250,000 and credit sales revenue for $250,000. but we don't record costs the same. There's no journal entry recorded at this step because we have not counted our inventory yet. So now they say record the end of period adjusting entry after you've counted the inventory and it's $30,000. So we need to go and we're going to debit cost of goods sold. We just don't know for how much yet. So I'm going to put that there as a debit, but we're going to come back to it. And I know I need to put into my inventory account, which I haven't done anything to. I need to put that $30,000 in there because I've counted it. And I know I need inventory ending of $30,000. Now we go to the accounts that we have been using as placeholders for our purchases and our purchase returns and freight, and we're going to debit and credit them, the opposite of what we did before. So we had credited purchase returns. That was the contra asset account. So we're going to debit that account. Now we don't need it anymore. It was merely a placeholder for the purchases that we made during the year that we did not put directly into the inventory account. We had an inventory beginning balance of $25,000, so we need to credit the inventory beginning balance account. And that's merely a distinction in Connect. Inventory ending and inventory beginning are both debits and credits to inventory. They just emphasized that it was ending and beginning. That's $25,000. And then we need to credit the purchases account, which we had debited in our first transaction. And that was for, oops, that was purchase returns. I don't want that. There we go. For 155. Yeah, 155. Credit. And then our final credit is to that freight account. Freight in. Because we had debited that account for $10,000 and we're going to credit that. So now if we just do some simple math, we've got an amount here in the credit balance and debit balance, and to balance all of that out, just plug this in and you'll get $148,000 to complete the periodic journal entries.